yesterday I was giving some thoughts about just how you go about recession proofing and how the methodology that I use for everything goes back to what is your position, and then from there your priorities, and then you get into to optimizing. And part of understanding your position is looking at your assets and liabilities, but also understanding all the risks that you need to hedge, both the downside risks, but also the or for worst case scenario, but also the downside risks for best case scenario. So work through that, and also I think we talked a little bit about putting together your plus minus list. So what are the things that you want to buy when they go on discount, and what are the things that you need to let go of in sequential order? What are the trigger points for that? And then getting really, really clear on your priorities. And I've had a lot of calls with folks who are asking me about putting money into the market and launching new products and so on and so forth. And what I go back to is, okay, if you want to put money into the market, here's the process. Have an account at Robinhood or Charles Schwab or Vanguard, etc. And then if it's 24,000, for example, that you have available to deploy into the market, then we're going to put it in over an 8 to 12 week range. So if we're picking 8 weeks, then we take 24 grand divided by 8. So that'd be $3,000 per week. If we pick 12, 24 grand divided by 12, that's 2,000 per week. I picked 24,000 on purpose because that makes the math easier, and I'm lazy.
Easy math. Yep.
So then what you're going to do is take that 24,000, put it into the, let's just say, Charles Schwab account, so that it's there, and then you're going to move it into the market in chunks once a week over that 8-week or 12-week period. Now, why am I saying 8 to 12 weeks? Well, if you listen to the BNY call, the Bernstein call, or if you followed even the things that I projected the first day we did the call, or even the most recent projections from Bill Gates, is that he says I think universally the data amongst all of those folks, and I just get to sprinkle myself in there because they all said something smart, and I basically just kind of got to copy it or piggyback off them. But they said we're about 6 to 10 weeks away from getting to some stability, and there's a fair amount of assumptions that go into that in terms of the financial markets, the liquidity amongst the banks, the solvency that exists amongst consumers, and then lastly, the public health policy. So what we've seen is that the Fed's done everything it can possibly do to give solvency or liquidity to the banks. BNY said by the end of this week we would have fiscal stimulus. It looks like that's getting done today. So that helps address the solvency issue to a degree. And then public health, we'll see. I mean, unfortunately, that's a huge moving target politically, of course. But all of those models and everything comes back to 6 to 10 weeks. So then I say 8 to 12. Just add in 2 weeks cushion. And we don't know if we're at the bottom of the market. I think I shared yesterday the VIX, VIX. It's a volatility index, which you can just go to Google and search VIX. And historically, it's around, it's on essentially a scale of 0 to 100. And usually it's at around 20, 25. And so when it goes up, that means there's a lot more volatility. So the lower that it is, the less volatility that we have. Right now it's at 62, which is still a lot of volatility. Historically, previous to this whole coronavirus thing, we had like 3 days where it was ever over 75. And then we had like a week plus where it was in the 70s. And it touched above 80 for a while one day. And so we're back down to in the 60s, 62 right now. Still not great. Still a lot of volatility. So Yeah, the markets bounced a little bit. That's to be expected once we finally got confirmation of the fiscal stimulus. But a lot can still happen. We start reopening, try to reopen the economy in the next 2 weeks, which has been floated out. I think that's going to add a lot of volatility to the market, and you may see the market react positively, or you may see it take another dip. And so that's a long way of saying we don't know if we're at the bottom yet. And humans are terrible at predicting when we're at the bottom. And there's about 100 years worth of data to support that. So you can Google timing the financial markets, and you're going to find lots of data around how most of the rates of return that you get come from a couple of days where the market had a big run. And so if you're out of the market on those days, you miss out on a significant amount of the upside. And so by trying to time the market, the likelihood of you missing those days is substantially higher. And so there's all this data showing how it's best to really keep your money in the markets so you don't miss out on those days. And so all that to say, we don't know if we're at the bottom. We're not good at timing the market. So we take that money and we chunk it in over a period of days, a period of weeks, 8 to 12 weeks. But that doesn't answer the question of whether or not we should put the money to begin with into the market. And that's where we need the priorities, understanding what we're really solving for. So when I'm talking with folks, and I'm in, I don't know how many calls per day at this point, but I'm talking to clients, what I'm asking them is, what is your number one priority? And for a lot of folks, they're having trouble articulating anything beyond financial stability, to which, if you're solving for feeling like you have financial stability, would you then want to take your money and put it into something that is extremely volatile currently? Nick, trick question here. If you're looking for more certainty, do you think that it would follow that you should take your money and put it in something with historically high volatility?
Negative.
Why is that?
Well,
it almost sounds ridiculous, right?
Yeah, you just said it. Yeah, I do have people. I'll give you a real world example. You have to know yourself. I think that this is what you do so well. And I think that I try to do in our consulting is you really have to know yourself. And, you say priorities. If you want financial stability, even if on paper it all makes sense, if you know you're the kind of person that is going to sit here and refresh your portfolio and watch it tank down, you're going to give yourself massive anxiety. You're getting further away from the thing that you said you want to optimize for, right? Which is certainty. And I know people doing that right now. Their number one priority is certainty, peace of mind, calm. But they're also trying to, sneak in something and time the market, get some upside. Yeah. And the worst, like I don't do drugs
except on Fridays.
What's that?
It's like I don't do drugs ever except Fridays.
Yeah. And so even though the people I'm talking about in particular, they're just fine. They could ride out the next 20 years with money in their bank. Their life has gotten worse. Quality of life has gone down because they're staring at this, they're staring at this trend, and it's causing a massive amount of anxiety, which is the opposite of the thing that they made all this money for, because they made the money for peace of mind, certainty, stability. So real world example of why, if that's your priority, playing in a volatile space is probably not the best move for you.
Yeah. Now, if you have a reserve account for investments that you've intentionally carved out money, and this is part of what we represent in terms of the different accounts, if you've carved out money for investments and your top priority is, I'm trying to get to funding my retirement, and it may follow then to take some of the money you've already carved out for investments and put it into the market over that 8 to 12 week period. This is money that you've already set aside that when an opportunity comes about, you want to jump on it. This is what, if you listen to the Bernstein call in particular, Rachel was talking about how her clients, she has so many clients who have sold businesses over the last 10 years. So most of the ways that people become clients of Bernstein or BNY is that they have an exit of their business and now they have this huge stockpile of money. What do I do with it? And for a number of their clients, they've wanted to just reinvest it in other businesses or just hold on to it in cash because the bull market was not particularly interesting to them, and they felt like, hey, I could get a much higher rate of return by investing in things that I have more control over. So there's this sum of money that they've had sitting on the sidelines, ready to invest and deploy. And so that's the point of having this reserve account to a degree, is that you've got money on the sidelines that when an opportunity strikes that's on your kind of plus minus list to begin with, you can capitalize on it. But we need to hedge our downside risk, which is why we don't want to just put all the money in the market now. We want to average our way into it over 8 to 12 weeks. And we want to split our aces. So there's not just opportunities in the financial markets. There's opportunities to buy businesses. And there's opportunities to buy businesses without using your capital. So there are, these folks, these high net worth folks that are clients of BNY and others who would love to be a part of opportunities. So the extent to which you're hearing about things being going on sale and you've got relationships with folks, maybe you deploy some of your capital into the opportunity, but also there's opportunity to bring on some of these other investors who are typically more keen to invest in businesses. That's where they got the most of their net worth to begin with. So a couple things just to keep in mind, but it all comes back down to what is your current position? What are all your current assets, liabilities? What are all the risks that you need to hedge, worst case and best case scenario? What are your priorities? Those priorities are going to help drive where you could be allocating your money. And then we get into the actual optimization, which is where the cash flow engineering really steps in. And so I think that's largely where, I don't know that some of you have seen this if you've been part of this group for a while, but I'll just share my screen for a moment. This is one of the spreadsheets that's part of the cash flow engineering series. Nick, can you see it?
Yep.
Cool. So we have what we call the case framework. So we compile, assess, and strategize. You can see a bunch of tables down here where we show revenue data, expense data, and then these pivots are essentially what we do once as part of the assessing and strategize phase. And then we've got some other analysis, something we call the Michael Scott principle, contribution margin, et cetera. So what we do in the step one compile is we go into QuickBooks or whatever our accounting system is. We run a report, expense details by vendor for the last 12 months. I do it last 12 months, not last year, because chances are you've made some changes in January and March of this year. And so January and February of this year and March of this year that are different than what you did a year ago in January, March. So I take a rolling 12-month. I dump it in here by vendor and the amount. And so these two columns are really what you take from QuickBooks. And then we're going to identify the frequency. Is it an annual expense, one time, monthly, bi-monthly, quarterly? And then we analyze what the behavior is. So is it so there's two types of expenses. There's fixed versus variable. Fixed is the cost. So rent, typically a fixed cost. Salaries, fixed cost. Variable would be like cost of goods sold. So when you sell something, there's some driver where the cost changes. And so that's what variable is. And then we have step fixed, step variable, just denotes that when something happens, the cost changes. It steps up. So salaries, for example, are typically step costs. You get to a certain size and then you got to hire another person. Or you get to a certain size, you need to take on more rent. So it steps up. in cost. So we're identifying, are these step versus fixed? And then what is the type of software, product, service? And then how often are you using it? And then we get into what is the annual savings. Okay. And so you might say, well, I don't know. Savings, there's savings associated with an expense. Well, hopefully, when it's salaries, that should be revenue producing, or when it's inventory, that should be revenue producing. But for a lot of things that we are buying, part of the reason how we've justified it is there's some benefit to this. It's the whole, time's worth too much. So I'm buying this software because I don't want to do it manually, because my time is worth too much. And so we need to go through and identify any associated savings with this expense. Nick, did you have something you want to say, or just trying to get me to? I saw you touch your face again, so I'm gonna.
Yeah, your hands look dirty, so I was
putting on. It's a trigger. Anytime Nick touches his face, I put on hand sanitizer. So makes me feel safe.
Yeah, I got you.
Thanks, I appreciate it. So we're identifying any savings, and then we're identifying the type of savings. So is it just a direct cost savings? We bought this, and as a result of buying this thing, we had a direct cost savings. Is it an avoided cost, or is it an opportunity cost? And so what is the type of savings? These things that we mark as avoided or opportunity costs, those tend to be a little bit more subjective. And so it's important to denote when we get to the analysis and strategizing phase, how much can we really count on this savings? How concrete is it? I use the term preponderance of data in our program. And so then we're looking at, this is just anything in gray is math. There's calculation. So you can see up here, we've got this whole series of if-then statements to quantify the annual and monthly savings, and then the effective cost. Now, what we're also going to add is, what month do we add this expense? Is it core, meaning can the business operate without it? Yes or no. If it's core, then it would suggest the business can't operate without it. And then what segment of your business does it relate to? And so there's a drop down here, and there's a tab with drop downs where you can add more descriptors if you need to. But what segment does it relate to? How long have you been in this? Have you engaged with this vendor? And then what is the relationship? Or what is the type? Is it relational or transactional? So with Nick, if Nick was on here, that's relational. I've known him for more than a year. Transactional, Microsoft. I have no relationship with Microsoft as it relates to paying them for Office 365 and so on and so forth. And then we have this whole thing, which comes from a lookup over here in our segment data tab, where we've identified, based off our different segments of our business, are those segments relational, and does the rule of 3 and 10 apply? If you're not familiar with the rule of 3 and 10, it means anytime our business triples or hits an order of magnitude of 10, everything breaks. I think you can invert that and say anytime your business goes down by these multiples as well, things are going to break as well. This is all compiling. Now, what we do with it later is in the assessment and strategize phase. So this data is incredibly intentional. I think Jackie's on here. She could probably speak to how she's leveraged this a little bit. But this data is really intentional because as we get to the assessment and strategizing phase, we want all this in here because it's going to help us to identify really what we're going to eliminate and when, as well as what are the trends. So oftentimes, and I've said this a few times, we add in the month added, because when we're analyzing our revenues over here, what we're going to see often is that we added these expenses in the months that followed a high water month. So we had our biggest month ever, and then is there a trend where we're adding expenses in the 2 to 3 months that follow? chances are yes. And so what that says is that those may not in fact be needed expenses. We just did an overgeneralization. So we're going to look at those trends to identify when we're adding expenses to help us evaluate, are they truly necessary? Are we causing ourselves to add expenses when it's in fact unnecessary? So this is a tell for how we can add in some new principles to try to limit that behavior in the future. It's also a tell to go, look, these are probably expenses we should cut if we're downsizing or we're in a recessionary period, because we added them because we anticipated more revenue, more growth. The segments, longevity, relational aspect is where we're going to find the hidden assets in our business and those opportunities where we may have a new product that we can create, or we can leverage the relationship with our vendors because they're relational and they're for more than a year, where we can go back and try to find a cost savings with them because it's relational and it's long term. And so we're mapping all this out in the compile phase, because it's going to be all the data that we need that's necessary to assess and strategize. So Jackie said, and she's been working on this pretty hard for the last month or so, she says, so doing this exercise and starting on the execution made the decision process for what to do as the current situation has escalated much easier. So she gathered all this work, all this data, and we had it, and I know there was a ton of effort that went into that. She got all of it in one place, and QuickBooks just gives you expense and amount. It doesn't tell you all the rest of this stuff. This is stuff you're going to add in, and it takes a little bit of time. But once you've got it there, this is really in the assess phase where you're identifying the trends, and the trigger points come in the strategy side of things. So now that we see all the trends, we're going to strategize on when what the tipping points are, and then ultimately the E in case is executing. So then we actually do it and continually recalibrate. So this is all, we touched on this over 6+ hours of training in the CFE course, but I just wanted to share this structure with all of you as part of kind of the recession proofing your business. So let me know what questions. Jackie says, and I can see now where there were expenses that weren't needed and won't be put back when this is all over. Yeah. So that's hedging the downside risk, right? So now we know the trends. So when revenues come back, there might be a tendency to add back stuff that you didn't previously need. And so we've added some guardrails there to try to prevent that from happening. So let me know what questions you have. I'm going to turn off the share here. Any questions about that? If you've got access to the Wealth Q&A site, the course is in there. We also have put a pretty significant discount on CFE, cash flow engineering, currently. So if you're a friend of mine on Facebook, I've been pretty railing pretty hard against other accounting professionals who are trying to leverage this whole coronavirus in a way to sell SBA lending programs and accounting cleanup programs, and let me help you with payroll tax stuff. Run the math on that. So if there's $50 billion that's been authorized for this disaster loan program, so $50 billion may sound like a lot of money, but they're going to give loans out up to $2 million. So if everyone gets a $2 million loan, then there's 25,000 businesses that are going to get a loan. I don't know how many millions of businesses there are in the US. There's quite a few. Quite a few businesses. Likely the average is more like 100,000. And so that does increase the number of businesses. But the reality is that not everyone's going to get this disaster loan. It's not a guarantee. And so need to be really careful paying for assistance on something when you're already in a crisis that's not going to get you closer to the answer. It doesn't mean you don't apply. I just think you put in the time, the couple hours, and we've got the instructions course, happy to answer questions on how to do that no cost. And then we've discounted significantly cash flow engineering program is already existing for folks that want help there. Nick, anything you want to add?
Yeah, I think just some stuff, maybe a little more esoteric, a little more meta, but there's a lot of talk all the time, especially in the marketing world, about some version of wisdom in decision making. And I think when things are good, kind of going back to Jackie, when things are good, there's all these things that you need. It's a wise decision to get this thing and that thing and save your time by hiring this person. And it's really important. Obviously, I'm biased. It's really important to have a framework through which is the cash flow engineering process and the workbook, which makes it much easier to organize all that to really determine what is the wise decision. Given the actual data and the ability right now. So Jackie, again, has the ability to execute and make decisions quicker. That's a huge advantage right now. And that I know what to do. It's clear to me. I run it through this process and I know what the best decision is for my business. And you can do that really quickly. And so we'll point that out. And then the fact that in my message, my front end message to my clients and the prospects, the people on my daily email list and all that stuff has been the thing that's not super sexy most of the time, but hopefully it's highlighted now, is that we're all chasing these revenue centers, these additional revenue streams, these profit centers. And as you go through this process, and I'll pick on Jackie again, as you start cutting these costs, that often the largest profit center is, I don't want to say loss aversion, but it's those sunken costs. It's those costs that have been going down a black hole for no reason. Even when things are really good, that's probably the biggest profit center, but I think it's the most important one right now. And just to go back to the Oreos, it's the very first email in the new email sequence. It is a massive profit center because all the money you save, $2,000 a month and cutting all these costs, can now get redistributed to one, put in your pocket to fund your priorities, could be put into advertising, could be pivoted over into a retirement account that gets interest, and it becomes it's more obvious that it's a profit center, right? We can reallocate those funds to something that gets a return over time. Super important though, because that's what we miss when times are quote unquote good and we're allowed to procrastinate a little bit and not address some of these things.
Yeah,
huge profit center there, and I'm encouraging people to look at it that way, because that's what we're all trying to optimize for more profit, and I think it's a good mental shift to realize this is a massive profit center.
Yeah, and say your profit margin is 20%. A little fun with numbers here. Profit margin is 20%. So for every 10,000 in revenues that you bring in, you have $2,000 in profit. So if you eliminate $2,000 worth of expenses, that's like you just brought in $10,000 worth of revenue. So folks work really, 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 really hard to bring in $10,000 worth of revenue per month. Like I just, if you brought in 10 grand a month in revenue, I just closed 120,000, right? That's what people would say in the internet marketing world, at least, because they take the 10 times 12. And you'd be super pumped about this 6-figure in revenue sale. But ultimately, if you have 20% margin, you're netting $2,000 a month. So much easier to go through, comb through your expenses, find the $2,000 a month now, eliminate it. That's as if you just brought in 120,000.
Mm-hmm. Yeah, and let's not forget the other thing. If you do $120,000 revenue, great, good for you. We're in business to do that.
It's an and. We could do both.
Yes, that's the big is we want to do both, but one carries more of a risk. I'm willing to bet saving $2,000 in expenses is actually a bigger win, because when you generate an extra 120, you probably take on a few extra expenses to fulfill on that. Maybe you need to hire some people. It's a little bit more work. It's good. We're here to work. There's nothing wrong with it. But the highest profit, lowest risk thing is eliminate the losses. It really is.
Yeah. Anybody have any questions or comments? Anything unrelated?
It's crazy how people have been saying you need to spend to make, just to spend or buy their product. Yeah, I always say you never ask a town barber if you need a haircut, right? Everybody believes you need their thing, whether you do or not. I'm going to give you another perspective, Jonathan, just piggybacking off of that because we got a little bit of time. You're not gonna make money for nothing, right? But the currency doesn't have to be money. You can provide service and get money in return. You can make a connection and get paid for that. You can provide an audience. There's a million things there's a million currencies you can use to make money that are not money. So I do think you need to provide something in order to make money. But the idea that you need to spend money, more specifically, you need to give me money in order to make money it's the unfortunate, juvenile, and potentially dangerous message out there.
Well, what was it that Randy was saying about inverting the process? Now is the most opportune time to apply the inversion technique, right? And I think what he said on Monday was something to the effect of when the answer is not readily apparent, then that's when you invert. And so invert is basically, what if we did the opposite? And that is not necessarily the answer, but as a thought experiment, at least, it's a basis or starting point for the answer. So right now, if the answers are not readily apparent to you on what you should be doing next, then given whatever the problem is, what if you did the opposite? What would that look like? And that becomes a path forward.
Yeah, huge fan of the inversion process. Strongly recommend listening to Randy. Strongly recommend Poor Charlie's Almanac, little Charlie Munger's little book of wisdom. Quite a bit of inversion techniques in there. Yeah. But don't. It's of course. There's just another rule of thumb, is that when taking advice, be hyper aware of the source. But if somebody gives you advice and they also benefit from you following that advice, I would be cautious now more than ever. So somebody says, hey, you need a webinar and I just can happen to sell you one. Like, well, they benefit from you taking that advice. So just be cautious. Have filters, frameworks. There's a whole bunch in the member area, in the cash flow engineering, wealth acceleration member area. A lot of frameworks to use. I purchased something a salesperson said.
Yeah. Just read it.
Yeah, I'm just reading here.
I think Jonathan's comment is around how there's salespeople who make guarantees. Mm-hmm. If you're not happy, we'll refund. And now, given the current conditions, they're not honoring their refund commitment.
Yeah, that's probably happening a lot right now. I generally speaking, just personal rule, I won't invest in something if it's life or death. Like if I might need the refund to pay my bills, I just wouldn't invest, because I have no control over what a salesperson says. There's a risk there. You have no control over what a salesperson says. You have no control. I'm not patient enough to read the fine print. Maybe you are. I'm not. So I won't make an investment if the refund is if I'm going to need the refund in order to be okay.
Yep. Megan points out no one knows the difference between revenue and unearned revenue. That's so true. Yep. So when someone pays you and you haven't delivered a service, or you've offered a product and there's some guarantee to a degree that that revenue is not earned. It's in fact still a liability, like a gift card, right? Gift card is a good example of unearned revenue. So the way that a lot of folks are running their business is as a cash business. Hey, I got paid, dollar in, dollar out. When in fact, you still owe that dollar. It's not earned yet. And so it needs to be reserved until you fulfilled the service. Yeah, and unfortunately, they're not reserving the funds. They're spending it, and then they've, in this unfortunate scenario when folks are asking for refunds, the money's already spent.
Yeah.
So this goes back to understanding your position. Really, step one: assets, liabilities. As you have some potential liabilities that are unearned revenue is an example of that. So getting clarity to the extent to which you have that unearned revenue.
Yeah, we've had another example. My second business was a nutrition company, and it was felt like a cash cow. We were making money like crazy. Got all kinds of cool tips and tricks from other internet marketers, cash flow infusion stuff. And I like to tinker with stuff. I like to find if something works. And what we did was we built in a ton of, hey, pay up front, pay for a year up front, get this kind of discount, a lot of money in the bank account, everything's groovy. And when it came time for me to exit to sell the business, things I didn't know at the time, we were actually in, I guess, what they call service debt, right? Where we owed more service than we had cash in the bank to pay somebody to cover it. That's kind of stuff you don't think about if you don't have any kind of cash flow engineering process, any kind of somebody that knows numbers, which we did not have at the time. And getting really, if we said, hey, Nick's leaving, we could not have refunded everybody for the amount of service we owed them. As much money as we had in the bank, it wasn't enough to cover that. Something I never thought about. So those are just things that happen.
So if you go through the process where you compile all your information and then you analyze the trends and you get to strategy and you see you've got a bunch of vendors that you have relationships with, rather than necessarily trying to launch a new product, one opportunity is to reach out to those vendors and see what kind of deal you can strike, whether they have something that you can resell to your audience, or whether there's a way for you to reduce your exposure to that expense through some form of partnership.
That's my favorite. I mean, you were there. Dan and I just got off a call with my my private clients, and one of the things we talked about was everybody wants to pivot. There's a great risk in doing a new thing. If you're on these calls, we've talked about that a million times. But strategic partnership is very, very, it's very appealing, and there's opportunity for to create win-win-win situations. So whatever business you're in, think of what else do your customers buy? What do they buy before they're your customers? What do they buy after? What is the next step? And you can make additional revenue, additional profits, also strengthen a relationship, potentially create a win-win without taking on the risk of the unknown, which would be pivoting your business into whatever you're thinking about pivoting into. It's a very, very high risk thing. So.
All right. Well, I guess let's see if anybody else has questions, and if not, we'll wrap up.
Yeah, drop your questions. We have tomorrow Dr. Michael Breus. Michael Breus tomorrow joining us. He is the sleep doctor. He shot me some really cool stuff. He said most entrepreneurs have disordered sleep patterns, but they don't have sleep disorders. Things like I can't shut my brain down at night. I don't sleep well at night, all that stuff. He's got some really quick fixes for that. Says I can get rid of that really quick. So he's going to share some of that stuff. And then there's some stuff. He mostly only works with really, really high end clients. Some stuff he's doing specific around this whole coronavirus things, a little bit for immune function, but also just to relieve stress, anxiety, and enable people to sleep better. So he'll be on tomorrow, and we'll jam with him and hopefully come away with some stuff we can do to sleep better. I think everybody needs that.
Yeah, cool.
Awesome.
Do we want to talk about our CFE affiliate program? Does anyone want to hear about that? And that sounds self-serving, so I'm reluctant.
Yeah, drop a comment. Just piggybacking off of partnership, we're walking. I'll just be transparent because it's what we do. It's one of the things that we're committed to is being transparent as much as possible. We've made CFE hyper affordable. You guys are in it. These are the calls we do. And just piggybacking off of one of the things that all of my companies are doing is trying to pull things together that our clients and our audience can also sell to provide themselves additional income. And obviously, we're biased. We think our stuff is really, really helpful. So we want to get as much out as possible. So Jonathan, Megan, who else has been active in here? Tristan, Jackie, if the cash flow engineering is something that you feel like your audience, your clients, your people would benefit from, we are setting up an affiliate, a partnership program. We're going to keep the price as low as possible. We're going to commission as well as we can just to get extra revenue streams for our people. And obviously, we're going to keep showing up and serving the best we can. So you can, whether you're watching live or you're catching the replay, you can let me know. And we can give you all the marketing assets and all that stuff. But it's a way to get more people in this community, serve them better, and it is a way to potentially get some of you guys and gals an additional stream of revenue that we hope you feel really good about selling. We hope you feel like I feel good about taking money for this at this price. So that's what we're doing. I'll send out some emails and we'll update you. But any interest at all, just let me know and I'll get you set up.
Cool. All right. Hopefully we'll see you all tomorrow with the sleep doctor, who's an actual, that's not just a hokey name, right? He passed the.
Yeah, he got his PhD in psychology and then said, hey, I'll go take the medical board exams and passed. So he's like one of 160 people that have ever passed the medical board exams without going to medical school. Yeah. He's very, very bright, bit of a savant, but he's put everything he has into sleep, which is good for us.
Yeah, that's awesome. Cool. All right. Looking forward to that. Looking forward to seeing you all tomorrow. And yeah, stay healthy.
Yep. We'll see you tomorrow.